Well, now it's AI. Okay. Well, maybe they're right, but on the other hand, back then they just overpriced themselves. So the NASDAQ 100 dropped 82% in 2 years. Okay. If we're topping, and I think we are, this asset category is going to cause, it's going to, like a tectonic plates are bumping into each other. It's going to cause ramifications in the T-bond market, and gold has already anticipated it.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fantastic discussion lined up today that I am very excited about. Today, we're fortunate to have with us Michael Oliver of Momentum Structural Analysis. Michael entered the financial services industry in 1975 on the future side, joining E.F. Hutton's International Commodity Division. In the 80s, Michael began to develop his own momentum-based method of technical analysis. In 1987, he technically anticipated and caught the market crash. It was then that he decided to develop his structural momentum tools into a full analytic methodology. In 92, the financial VP and head of Wachovia Bank's trust department asked Michael to provide soft dollar research to Wachovia, and within a year, he shifted from the brokerage side to full-time technical research. He then founded Momentum Structural Analysis, and he also became a published author. Michael, thank you so much for joining us today.
Thank you, Gary. Good to be here.
All right. Momentum Structural Analysis looks at the market from a somewhat different point of view than other analysts do. Rather than focusing on price, something that virtually everybody does, MSA tracks momentum, which reveals trends that have been building for a long time and have much more depth to them and staying power. Can you speak into that for us?
Sure. Price is, you got to remember, when you measure something by price, you're using a ruler that is a fiat currency, okay? Which means you're using a rubber ruler or elastic ruler. It's not constant. If you built a house and you had a ruler that said 3 feet, and then 6 months into building it still said 3, but it actually grew, then your house would fall apart. Okay, so if you bought a stock at $10 and a decade later it's worth 20, you think, oh boy, I'm making money. No, you're not. The money supply basically doubles every decade. It has since the late 50s, regardless of whether you have a recession in that decade or not. Basically, they keep printing the money for one reason or another. Anyway, they're going to have a new reason coming up this year, and that's going to be the stock market is going to contribute to their pain. We think it's been topping since 2022, and when it does, you'll have more money expansion. Anyway, what we do when we measure price, we take it and we measure it versus the momentum of the market in question. Now, some markets are dull, in which case they have very little dynamics. And so when you measure the momentum, it doesn't reveal much more than it's dormant. Okay. When a market is dynamics, then that moving average underneath it, for example, rises more rapidly. Okay. In which case, instead of just measuring the price, you measure it in relation to its own dynamic, namely the dynamics of its own moving average. No, you're not totally separated from the money unit, but you're partly separated. So to some extent, we've taken a half step away from price analysis. And usually we come up with different pictures. In other words, what you see on a price chart might be what we see, but quite often it's not what we see on momentum. And momentum almost always, and I stress that, almost always, will anticipate a top or a bottom before it's evident on the price chart. And you can measure, we measure long-term momentum, intermediate, short-term, with a focus mainly on the longer-term stuff, the bigger trends. Anyway, that's our methodology, and it's not the same as what we call the wet noodle indicators. Like, you know, when you get a quote screen, there's an RSI. It's like a little noodle that goes up and down. What we develop are structures that have snapping points. You know, it's not just, is it high, is it low, but is there a structure to break? You know, like a floor or a ceiling or an uptrend line. And quite often it'll show up on momentum, won't show up on price.
So very interesting. And you talk about these snapping points, these trends, these structures. Michael, markets obviously do move in trends. They move in cycles. They leave clues behind to their directions and movements, which you're talking about here. What the market's like, what they don't like, what it prefers, what it doesn't prefer, what's in, what's out, what's mediocre, what's struggling. I mean, it's all these clues are in there. So basically the markets are speaking if we're listening. Currently, what is the S&P 500 and NASDAQ commodities, gold and silver markets? What are they saying right now? What clues are they leaving behind?
Well, let's go in that order. The one that's most confusing to people right now, but not to us, that we could be wrong. The S&P, I think, effectively topped the NASDAQ 100 in late 2021, early 2022. We know we put out a sell signal. We said, be gone, if you're an investor, that is. Be gone from the stock market. This would be January of 2022 for the NASDAQ 100, which is the leader index. It was massively more upside than the S&P from 2009 to 2022, like double the S&P. And sure enough, it broke. We had a good sell-off, not a major bear market, but 25, 30% drop. And then we rebounded, and it took us 2 years plus. Finally, you've come up in the last several months, and you've nipped out, taken out the highs that we saw in late 2021 on the NASDAQ and early 2022 on the S&P. Everybody says, oh boy, whole new leg starting. Well, maybe. We see it as a protracted topping process, much like it happened at the dot-com top. That top, we gave a sell signal in January 2000, and it wasn't until January, February 2001 before it really started to expose itself. In fact, after we said sell, the market made new high in August of 2000. Minor, but still new high. Looked great. Price looked good. Momentum said, don't trust it. This time the top is more protracted, and it makes sense. Why did it take so long to top the beast? Because the beast is triple the size of prior bull markets, both in time duration. Most prior bull markets, like 23 to 29, the dot-com bubble, it was like 5-6 years. Real estate peak in 2007, that was a 5-year bull market. S&P had doubled. This one is 2009 to 2022, or now 24. So it's 15 years of upside. And instead of a double, triple, or even a quadruple, it's 7 to 8-fold up in the S&P, 17, 18-fold gain in NASDAQ. Now you say, well, everything's better now. Well, look at the money supply M2 chart. You'll figure out what filled the tank. And then look at the Fed funds rate chart. And prior to each of those bubbles, we call it the dot-com bubble, right? Okay. NASDAQ 100 after that great move, and it was justified. Dot-com people said, internet's going to change your life. And it did, more so than they even thought. Well, now it's AI. Okay. Well, maybe they're right, but on the other hand, back then they just overpriced themselves. So the NASDAQ 100 dropped 82% in 2 years. Okay. If we're topping, and I think we are, this asset category is going to like a tectonic plates are bumping into each other. It's going to cause ramifications in the T-bond market, and gold has already anticipated it. It has anticipated that when that asset category breaks, we know what the Fed always does. They go berserk. They print. And once their other mandate comes into play, the employment one, other than the inflation one, which are contradictory, right? Once you start getting the data points that say, oh gosh, we got an in-pain economy, and they will. The data points will always follow the stock market, not the other way around. The stock market starts to break, you'll start to get the shift in the data points, and the Fed will have to revert to their other mandate. Gold, I think, has known that. It knows what's coming. It knows a bubble when it sees one, and it knows when a big bubble breaks, there's a lot of pain. And therefore, the central banks, not just here, but Europe, et cetera, will go berserk again. So anyway, one hits another. One category hits another.
Yeah. Okay. I appreciate the way you laid that out. And I appreciate the way you touched on the different bubbles. And I do want to ask you a question pertaining to the artificial intelligence trade, if you view it within your analysis as a bubble similar to the tech bubble of 99, 2000, or do you see it more like 1995, which was the beginning of the tech stock frenzy, or do you even see it as something else? And as a sidebar, you did touch on the other, Fed mandate on employment. So as a sidebar, do you see AI and robotics cannibalizing jobs and escalating unemployment levels at some point?
That's
and
a
making
fundamental,
making it more difficult for those who become unemployed to re-enter the workforce at some point.
Elon Musk has expressed concern about that issue, and so have others, about the impact on employment. And I'm not going to have an opinion on that. We're looking at it technically, but I can identify a bubble technically, compare it to other ones, see the consequences of the breakage of the bubble, see the connectivity between the creation of the bubble and Fed rate policy that fueled the tank, and know that when the bubble breaks, you have real world pain. 2008, 9, remember that we were a full year off the high before suddenly the average guy in the street, not a stockholder necessarily, felt personal pain. And right now, we're already seeing some of that. When you look at the employment data and really look at it underneath the surface, you see that, this job growth, it's been in what? Home care workers, hospitality, hotels, and also government. Okay.
It's also been revised down.
Yeah, I know. And
not
also,
every month for the last.
But even the last 4 months, if you look at the major sectors that you would call the economy, they've been ugh. Okay.
Right.
So the reality's not been what it seems to be, even though Powell wants to tout that. He's going to be faced with a reality that is painful for him, because he's going to have to revert to the other side, the other mandate, whether he wants to or not. And I know he wants to have a legacy as the guy who didn't do QE again, Well, we'll see. We'll also see whether the Fed even exists in 5 years, because I've made the statement before that I suspect after this next downturn in the stock market, the bubble breaking and the pain associated with it, that there's enough people out there on both sides of the economic spectrum, Keynesians even, who think, it hasn't been working, the boom bust cycle of the Fed. And
that might take a huge act of Congress to make.
I don't think there'll be a Fed in 5 years.
Wow, that's a big claim. So, speaking of the bubble, though, many want to know if the current market bubble, do you foresee a blow off top kind of a move coming, a stagnation move, a drop or crash in the next 6 to 12 months? Like what is your analysis pointing to in the more immediate future?
No blow off top. I think we've already had it in the stock market, and that was from the COVID low in 2020 to the 2022 high. And that was, we know what funded that. The Fed went berserk, at the COVID low. They printed. They even bought ETFs, high yield corporate debt ETF, and various. They did what the Bank of Japan has done before, literally buy the stock market. Okay. And when they ceased buying, of course, the market peaked. And they ceased buying those ETFs. But right now, I think the only blow off you're going to get is you're seeing it. And that's like in NVIDIA and a few other stocks. But even the former leaders, the narrow leadership, which used to be Apple and Microsoft and some others, it's narrowed down even further now.
Really has.
Where you're talking one or two. And the nature of the technicals of NVIDIA, for example, are such that if it turned down now, I think if you get back, under 1,000, you get back in the 900s again, I think you could implode. I think you could go to 500 in a heartbeat. It has the potential to have a crash type event. The stock market, I don't think the first wave down will be a crash event. In other words, the first 10% or so, I don't think you're going to get a crash, by the way, in my definition, is like 30% or more in 2 weeks.
Okay.
That's 1929, 1987, also the COVID crash event, a couple of weeks. A 10 or 15% drop is not a crash. Okay. And of course, I know what gold and silver investors are worried about. They think there's a linkage in such events to a sell-off in gold and silver, which is not always the case. And I don't think it'll be the case this time. I think they're total opposites. Anyway, but these major event flows and the shifts in these trends will impact each other, including the T-bond market, for example, which is, as we know, as the stock market's risen over the last couple of years, stock market made a low in 2022, made a lower low in 2023, and is now trying to go back and take out that low even. That's questionable whether it will. I'll talk about higher yields, which has what? It has a choking effect on too many financially related and commercial real estate related categories of the stock market. Stuff people aren't watching anymore. They should be watching RWR, the REIT ETF, or VNQ. They're very vulnerable looking. And I know while everybody's looking at NVIDIA going into space, they should be watching these very, very anemic sectors like the banking sector and the REIT ETFs.
So you see the commercial real estate issues having an impact on the banking sector, more like the regional banks?
Yeah, it was sort of like, well, back in March a year ago, we had a crash in the bond market. In fact, we called it. It was in January. We said the banks are vulnerable. They were looking real good then, by the way. Banks were even stronger than the S&P relative basis. But we could see the technicals setting up for a crash event. And sure enough, we had a crash, meaning we had more than a 30-something% drop in a matter of a couple of weeks. Stock market tended to reflect it a bit, but what's happened since is extremely important. Stock market's gone back, well, S&P 500 with 5 leadership symbols, let's say, and NASDAQ went up and made a new high. Look at the KBE. It's in the lower half of its zone, and now, in fact, it's lower than the lower half of its zone since that 2022 high to the 2022 low. It's just comatose. And you look at RWR, or VNQ, the commercial real estate ETFs. They're like in the bottom third of that zone. It's like, they're dead. Well, the problem is there's some technicals right now that are being challenged in those ETFs that suggest that if they roll over just a bit more than they are now, like a couple percent even, they're going to start breaking momentum structures that argue to us that the floor we saw is not going to hold. And suddenly they'll come back to the forefront in terms of, what they're talking about on CNBC and Fox Business News instead of NVIDIA. Okay. Right. So ambush.
Well, that's something that we should be looking for.
Yes.
So, U.S. debts are approaching 36 trillion. I mean, it's just hard to fathom that I could even say that. It's basically a fresh new $1 trillion in debt added every roughly 100 days.
That's right.
The deficit spending is a record for a non-wartime period. If there is a war or a recession, the U.S. will likely see 4, 5, 6 trillion or more in deficits. Mm-hmm. At the same time, countries like China, Russia, Saudi Arabia, and so many others, they're either cutting back on purchasing our debt or they aren't buying it at all. Mm-hmm. Clearly, the Fed has there's really no choice but to monetize some or all of this ever expanding debt issuance. Mm-hmm. What does that mean for the purchasing power of the dollar long term and the value of the dollar versus hard assets? And are you anticipating a devaluation of the dollar coming?
Well, there's some Trump people that are advocating that, but just looking at the dollar index, it's called an index, but really it's 57% the euro. Okay, but the dollar index has been the most comatose category for the last couple of years. You look at what happened in 2022, it peaked at 115 and it collapsed down to 100, slightly below, I think, at one point, and then leveled off in the low 100 zone. But that zone of action for the last 2 years has been the dullest it's been in many, many years for the dollar. So as an asset category, we look at the stock market, it's been moving around. Gold, silver, commodities went up, came down, going back up again. There's a lot of volatility in the T-bond market. There's a lot of volatility there, but that category, the dollar, or Forex markets, the major ones, is totally asleep. So it hasn't been a factor. But technically, the dollar index right now, by our analysis, using quarterly momentum, which is a fairly long-term metric, you don't see this on the price chart. You just see a sleepy, happy, sleepy market. Okay, there's an uptrend structure that you're toying with right now, such that if you drop the dollar index a point, less than a point actually, below where we're trading right now today as we're talking, we're going to break that structure. in which case it tells us that the dollar index is going to come out of its sleep zone and start to become noisy again. You know, what do they say? Watch the quiet one. Okay. The quiet one's about to make noise. And you break that trend structure, and that's going to fit with what you just said. Anticipation of what? You know, central bank having to panic regarding the government debt market. Good look, and also another thing to look at. And by the way, we think T-bonds could have a major rally this year at some point, meaning a drop in rates. Not because the Fed wants it to, but because it's oversold and it's got technical justification for a large counter-trend rally. The major trend of bonds is negative, very negative, but you could get a counter-trend rally, possibly as an alternative to weakness in the stock market at the same time, where
that would make sense.
Enough asset managers say, hey, I'm this risk asset, too much risk, not enough reward. I'm going to lighten my stock position. Where do I go? Well, there's gold and silver, and then there's maybe T-bonds will be an alternative this time. Okay, and that would reflect, you know, the drop in rates that would also hasten the dollar's break. It could be a component. The dollar is something to watch as a noise factor.
Well, so you bring up, you know, the treasuries. The U.S. bond market is roughly 51 trillion. It's the largest in the world. The global debt market is estimated at more than 130 trillion. Global sovereign debt has had major problems the last few years, as you were just talking about. Central banks are buying a lot less of it. Instead, they're buying gold. So if just a few percentage points of that 51 trillion in U.S. Treasury debt sold off and went into gold, that would be a massive amount trying to pile into a much smaller asset class. What do you see happening there in terms of a trend over the next few years, and how much of that bond market can or will actually sell off and rotate into gold? And what would that mean for gold?
Well, I think it has already. The sell-off in bonds has discouraged people from. Remember, in the past, you go back to the 2000 dot-com peak, 2000 to 2001, and look at the real estate peak in 2007, stock market now, okay? When the stock market rolled over, if you bought gold and T-bonds, you made money. They both went up together, meaning yields dropped while gold rose. This is 2001 to 2002, and also 2008 onward, T-bond, 2007 to 8, gold and T-bonds went up together, so yields dropped. This time, what do we have? We have gold rising, but T-bonds dropping. But I think there's a snapping point where suddenly T-bonds could get back in sync with gold. Why? Because they're simply vastly underpriced. And maybe, and I don't want to stress this as like a fundamental gut guess, there's an assumption that maybe if Trump wins, there's enough GOP folks in there that are really going to cut the budget. And therefore, maybe the trajectory of spending that we see now is going to be confronted.
It would be nice.
Well, I mean, it's possible, but you know, that could be a factor in forward pricing. Okay, we look at it technically, and we know that the T-bond market does have sufficient momentum trigger points, not far above, that if you hit them, and I'm going to bet that if T-bonds break out and do have a strong intermediate trend surge, drop in yields, you're going to see the S&P going down at that time. In which case, T-bonds will get back in sync with gold for a period. As far as the trend, time, you mentioned years, gold, for example. No. I think what we're about to see here, mostly in this year, is an acceleration phase in gold and silver that will take your breath away. No longer the arm wrestling process we've seen from 2015 to the present, where gold gains a couple $100 and then congests, bores you to death for a year, maybe 3 years, like we just had, and then goes up again and then congests. I think we're now in a phase, as occurred in 1979 to 80, where gold and silver went vertical. Silver especially went vertical, and also happened in late 2010 through 2011, where after years of upside, gold and silver engaged in a way that took your breath away, especially silver. I think we're at that point again, and I think this time it's even bigger, given the fundamentals, well, the charts and stuff we've been talking about, the dynamics of a potential stock market drop and the consequences, and therefore the consequences for the Fed, and the dynamics in certain other markets, like if the dollar starts to break, it'll suddenly become a factor again. And I think gold has known that. That's why it's behaved in such a steady, persistent way for the last few years. It just keeps coming back up. They knock it down, but it won't stay down. And now, it's even a better place to be. People are measuring than the stock market's been for the last several years. It's actually been better.
Yeah. So as you just pointed out, gold's broken through this 4-year resistance to reach these all-time highs that we've seen. It's pulled back, it's gone higher, and now you're saying it's positioning for this acceleration phase. But do you expect it to pull back to that breakout point of the resistance area of around 2100?
No.
No, you don't.
No, I think we've entered the acceleration phase. And by that, I mean, we got our signal that the congestion zone of the last 3.5 years was over, not because gold price went up to make a new high, but because our annual momentum of gold, silver, and the miners, using like GDX, for example, when we plot our annual momentum oscillators, we have a different picture than what you saw on the price charts. In silver and miners, we had what? Staircasing decline.
Mm-hmm.
It's somewhat irregular. In fact, you couldn't even draw a real good trend line. But on momentum, you had this perfectly flat basing pattern where each of the highs, even though they were irregular on price, were flat, perfectly horizontal on momentum. So if you'd have seen the momentum chart, you said, oh boy, what a breakout is pending here. And it occurred just above $25 in silver.
Mm-hmm.
Now, it wasn't until you got well above 26 or 27 that the price guy said, hey, this is looking pretty good. But momentum said just above 25, you're out of here. And on GDX, for example, it said at 3150. We surged to 37 rapidly. Now we're congesting 35, 36, 37 zone. I don't think you pull back to the $2,000 goal level or anything like that. I think you have these minor congestions that last maybe a week or two, like we've seen repeatedly. In April, we had a 2-week drop. Boom, back to the highs quickly. Silver made new highs. I think that's the pattern you're going to see for the next several quarters. And I think a lot of the move that we're talking about, ballistic, is going to occur in a matter of quarters, not years.
Wow. So what indicator are you watching? You talked about it breaking and going vertical. What indicator are you watching that's going to break that'll tell you, okay, it's happening?
It's already broken. It's already broken. It's that annual momentum structure. And it was not just gold. It was evident on the miners and on silver, almost coincidental. Even though their price charts didn't look the same. Gold was pushing at its old highs, but silver at $25 plus, that wasn't challenging any prior highs. I mean, we had a peak at 30, we had one at 28, and a bunch of them at 26. But momentum said, no, that's it. That's the real breakout. And the miners, the same story. And so when they went through it, you had this jolt that sort of surprised people, much bigger than they expected.
Yeah.
In that jolt, if you measure it properly, miners beat the pants off of gold. And silver beat gold on a percentage gain since, for example, the February lows. Much more in silver in the miners. And I think that will persist.
Is there something that you could point to, maybe not even definitively, but something out there that would lead you to believe that led to that breakage happening? Is it just that is it that the market is kind of topping? Is it that people are getting worried, over some war thing that's happening over in Israel?
I don't think war events. My historical view of war events in gold is nothing. They're nothing. Mm-hmm. They're more macro events, particularly what causes the state, the governments, central banks, not just here but elsewhere, Japan, Europe, etc., to go on a bender. And they're always on a bender. We know the money supply doubles almost every decade, but it's done even more than that this decade.
Right.
Okay.
Right.
And you put them in a situation where they have to defend yet another collapsing bubble, and they always come to the defense. When that stock market breaks, they claim they're not looking at the stock market. This is baloney. Every time you start to see vulnerability in that market that spooks them, they start pumping like crazy. And this is the biggest bubble in history, and therefore its consequences, at least for this year, could be enormous in terms of ripping the heads off central banks and causing them to revert to what they do best,
right.
As you said. And gold knows that, and that's the driver of gold. So that is the dynamic. And I think what happens is there's so much doubt that people see that they're accustomed to the behavior of the last 3 years. They think that's the norm. And it's totally not the norm for gold or silver. In fact, if you'll punch up a logarithmic scale chart of gold, go back 50 years, in the 1970s, and same with silver, and you look at the ratio scale chart, and you look at the last 3 years, it's like a little tight piece of ink in that chart. It's like abnormally tight. So instead of a normality, which people are now accustomed to, sell it, rally, it's overbought, that syndrome. Suddenly now they're facing a different reality, but a lot of people don't realize it. What was overbought any time in the last 3 years is no longer valid. It's false technical. We have a new dynamic. And I think it's going to be like 79. It's going to be like 2010 and 11, where you go vertical.
Wow. So, Michael, no one has a crystal ball to know exactly where an asset's price is going to end up. However, with your scientific methodology, you likely could get into a close range with all the factors present. What's your analysis pointing to for the price of gold? I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual, metals and miners, and every single expert interview that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I am positive that you've enjoyed this conversation with Michael as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video.